Okay, Chapter 6, Individual Deductions. This is kind of a long chapter, so to break up the monotony, I'll probably do this in two separate parts over a couple of days, kind of like I would do this in a regular classroom. Because this chapter is just way too long and there's a lot of concepts to go over. Some we've kind of hit on already, but not all of them. So I think it'll just be a better learning experience for you if we do this over a couple of days. And so, again, the deductions for individual taxpayers are lumped into two categories. They're either for AGI, deductions for AGI, or deductions from AGI. What we'll talk about today is deductions for AGI in more detail. Some of them we've already hit on, but here we go into more detail. And so, first thing that you have to realize is, and it makes better sense to do this, is to try to lump these deductions for AGI in one of the three categories that they relate to. And so deductions for AGI are either directly related to business activities, some are indirectly related to business activities, and then as we've seen, there are some that don't fit into either one of those two, but somehow Congress decided to pass these as AGI deductions, and so the book categorizes this as deductions subsidizing specific activities. And so the first category, directly related to business activities, taxpayers are allowed to deduct expenses incurred to generate business income. Now, you have to further lump these business activities into either profit-motivated activities or activities motivated by personal objectives. Only profit-motivated activities, business activities, are deductible for AGI. If it is motivated by personal objectives, well, what does that look like? Well, it looks more like a hobby. Many people who make money in other areas decide to have these expensive hobbies, such as owning and breeding horses, racing them, owning exotic vehicles, maybe racing the vehicles. So the question is, well, are they doing this as a profit-motivated activity or just something else, a hobby? Only profit-motivated activities are, the expenses from profit-motivated activities are allowed to be deducted. We'll talk more about hobbies later. Further, profit-motivated activities are classified as either business activities, called the trade or business, or investment activities. Now, you might remember, if it's an investment activity, unless it's related to rental and royalty income, it's a from AGI deduction. If it's an investment activity that generates an expense related to rental and royalty income, then it's treated just like trade or business expenses. It's deductible for AGI. And so, even though both are motivated by profit making, business activities are distinguished from investment activities because trade or business activities require personal involvement. Sometimes, and usually, if you're in a trade or business, it requires your utmost personal involvement. It's not unusual for self-employed people to work 60 to 80 hours a week or more. Investment activities, not so much. There are certain investments you can just put the money in, and you buy that investment, and you just sit back and enjoy the fruits of the income from that investment. So most investment activities don't require a lot of personal involvement, day-to-day involvement. And so what we learn, and this is a good exhibit here because this pretty much sums up how you treat these business activities or investment activities. Self-employed business expenses are deductible for AGI. Investment activities are, for the most part, from AGI deductible business expenses, except for rental and royalty expenses, which are deductible for AGI. And then the other category they have here, not sure why, unreimbursed employee business expenses. I guess it's related to a business activity, but you're actually an employee, you're not self-employed. I guess that happens, but I mean, every employer I've ever had reimbursed me dollar for dollar for business expenses. So it's pretty unusual to find that situation. You got to have a pretty sucky employer. Now, you might ask yourself, if you look at Form 1040 under the for AGI area, if you look at it and you don't know the answer to this question already, you're looking at lines 23 through 35, and you're going, well, gee, I don't see any self-employed business expenses here, or for the deduction of rental and royalty expenses. So where do I put this? Well, the key here is you have these other forms for self-employed business expenses. You're going to have an attaching form, Schedule C, that's going to list your income from self-employed activities, business activities, and you're going to get to deduct self-employed business expenses from that income to come up with a net income or a net loss. And that number gets transferred, whatever the net income or net loss is, gets transferred over to the 1040 online, as I look for it. Now, if it's rental and royalty expenses, you're going to file a Schedule E, and then transfer that over as well. Okay? So, again, what's a trade or business expenses? It's got to be directly connected to the business activity. You can't be paying your mortgage payment on your house that you don't use in your business in any way or fashion out of your business account and expect that to be a deductible expense because it's not directly connected to the business activity. One of the most difficult things you'll see with self-employed people is they're good at what they do, but they're not necessarily good at keeping records. And especially if they're just starting out, there's a tendency among small business people to have one account for both their personal expenses and their business expenses. And sometimes you don't really get a chance to advise them until maybe it's too late. They're now in an audit and they realize, holy crap, I've deducted things as a business expense that were in reality a personal expense, or maybe their records are so bad that they don't know what they've done. So that's something you just have to deal with at the time. I mean, you can't control what your client's done in the past, but hopefully you have clients who are actually listen to what you say, and if you get them early enough, the first thing you advise them to do is segregate your business accounts from your personal accounts, and don't pay personal expenses out of the business account, because you kind of have to, when you're self-employed, you kind of have to gear yourself towards the possibility of, well, what is this going to look like in an audit? Not very good. So hopefully you have the kind of clients that come to you before things happen, bad things happen, and that listens to you and takes your advice for how to set things up. Now, if it is truly a trade or business expense that's directly related to a business activity, you have to meet 3 other requirements in order for it to be the expense to be fully deductible. The expense must be ordinary and necessary for whatever activity the taxpayer is doing. Now, what does it mean to be ordinary? Well, it just means that it's something that would be expected in that line of business. It doesn't necessarily have to be a recurring expense. It can be a one-time deal as long as it's something that is expected to happen or expected to be incurred in that business. Necessary just means that it's helpful in carrying on the trade or business. So as long as it's helpful, that's good enough. Now, the third, or I guess maybe the fourth requirement for a trade or business expense to be fully deductible is that it must be reasonable in amount. And, you know, you kind of think, well, that makes sense. I mean, when is a business ever going to pay more than what's reasonable in amount? Think about that. When would you pay more than what's reasonable? Well, usually one scenario creates this issue. Anybody have an idea of what that might be? What's the scenario around reasonableness? Because, I mean, think about this. Most of your transactions are going to be arm's length, meaning you're dealing with a non-related third party. And so, if you're an astute business person, you're not going to pay more than what's reasonable, right? Because that's just money out of your pocket. And so where this reasonableness comes up usually involves compensation to related parties. Could be the owner himself or herself. Could be a spouse, could be a child, could be a nephew, you know, some related party. And you pay them a salary. And you pay them more than what normally you would pay someone if this were an unrelated party. And so that's what the IRS is looking for, making sure that you're not somehow shifting income to maybe a son or a daughter who's in a lower tax bracket. In that case, they'll allow you to deduct a reasonable amount, but that excess, they're not going to allow you to deduct that. Now, rental and royalty expenses, even though they're investment activity, are treated just like expenses from a trade or a business. They're claimed for AGI, and this could be an investment activity or trade activity, depending on the facts. Doesn't really matter. And the one difference here is if it's a rental and royalty expense, the revenue and expenses related to this rental and royalty activity is reported on Schedule E, and then you transfer the net income or loss over to Form 1040, line 17. So, line 17 says rental real estate, royalties, partnerships, S-corps, trusts, etc., etc. So notice here, line 17 is actually for a couple of things, and of course you would first put it on Schedule E, and then that would transfer over to line 17 of your 1040. If you have income, deductions, losses, gains from a flow-through entity, it would also go on this line, and you would also have to attach Schedule E. So it's a little more than just that, than just rental and royalty income and expenses. What if you have a loss? You dispose of an asset in a trade or business, and it's a loss. You sell the asset that you use in your trade or business activity for a loss. Well, you get to deduct the loss for AGI. Well, how is that treated if it's an investment activity? Well, if what the loss comes from in investment activities are capital assets, and they almost invariably are, then what you're going to do, we'll look at this in the future, but you're going to have to offset the loss from that investment asset against any other capital gains. And again, if you don't quite understand this now, not a problem. We'll talk about this in more detail later. And so you have to go through this netting process of this capital loss you might have on the sale of this investment asset. You have to net that against other capital gains. And if you have what's called a net capital loss after all the netting process, you can deduct up to $3,000 for AGI, and any excess of $3,000 gets carried forward indefinitely to subsequent years. And so know that if you have a loss from an investment asset, that's going to be under line 13, and you're going to have to attach Schedule D usually. And then if you have a loss from the disposal of an asset you use in trade or business, you're going to have to probably attach Form 4797 and then list that loss or gain in line 14 of your 1040. So notice some of these items, even though they're talking about for AGI, are actually not in the sections where it talks about adjusted gross income, which is lines 23 through 37. Some of these, you don't even get to that. They're in the income section of 1040 and attachments. So not everything that's a for AGI deduction is actually in the AGI section, is my point. So it's a little bit confusing, I understand. First time I did this is I was like, okay, if I'm self-employed, where do I take my business deductions? I mean, I know I can, but it's not in lines 23 through 35. Well, no, it's in Schedule C, and you just transfer over the difference between your income and your expenses to line 12. So it's a little confusing, I know. The next category of deductions for AGI are deductions indirectly related to business activities. And the big one here is moving expenses. Now, this relates to employed persons. This relates to persons who are in between jobs. This relates to persons who just graduated and got a job, got their first job. This relates to persons moving from one location to another for the same employer. And it relates to trade or business activities. Well, a self-employed person who moves. Okay, so I mean, this is pretty broad, this moving expenses. And so the cost of moving personal possessions certainly is not a direct cost of doing business or being employed, but yet it is deductible, the moving expenses, subject to certain requirements, for AGI. So the first two requirements in order for the moving expenses to be deductible is that they have to meet the distance test as well as this thing called business test, the business test. All right, so the distance test just says that the new job site must extend the existing commute by, let's make sure I get it right. Sometimes it's more than, sometimes it's equal to, and equal to or more than. So I just need to make sure that what I tell you is correct. Yeah. The new job site must extend the existing commute by at least, so equal to or greater than 50 miles. Okay? So what you have to do here is you have to compare the taxpayer's commute from their old residence to their old job and what the commute would be from their old residence to the new job. Okay? And the difference has to be at least 50 miles between those commutes. So let's say you taxpayer commutes 20 miles from their old residence to the old job. And they get a new job and they move. What must be the minimum mileage from the old residence to the new job for it to meet the distance test? Well, it must be at least a 70-mile commute from the old residence to the new job, because the difference is 70 minus 20. That's at least 50 miles. So what is Congress trying to do? Well, imagine in a big city. I'll use Dallas. If you've ever been to Dallas, it's spread out all over the place. And let's say you have a job in the city next to Dallas, Fort Worth, and your commute there is 30 miles. And now all of a sudden you get this new job, or let's say it's the same employer, but it's a different job with that employer, because as it says, a new job site is required, but a new employer is not essential. It can be the same employer. Let's say you get a job on the other side of Dallas. Now your commute is 60 miles. And so if you've ever traveled from Fort Worth to the east side of Dallas during rush hour, you know that that is just not a fun drive. I mean, it's just traffic wall to wall, bumper to bumper. And so you say, screw this, I'm going to move to the east side of Dallas because I can't stand this commute. Well, you can do that. It's just not going to be a deductible expense, because the commute from the old residence to the old job was 30. The commute from the old residence to the new job is 60. So that doesn't extend the existing commute to the new job by 50 miles. So they're you know, sometimes it's a no-brainer. I mean, if you transfer or get a job in a different city that's in a different state, that's a no-brainer. But this is meant to stop those situations where you're moving from the west side of town to the east side of town, or the north side of town to the south side of town, or whatever. It's got to be a pretty good commute, pretty good distance. On top of the distance test, the taxpayer must meet this thing called the business test. I would call it the time test more than anything. And so all this test requires is that the taxpayer must be employed at least 39 of 52 weeks, or be self-employed, if they are, for 78 of the 104 weeks following the move. Well, note here what's in effect. You don't have to be employed for the whole year. And as a matter of fact, this 39 or 72 week period can cover more than one tax year. If it does, I mean, you know, even if you're in the middle of working those 39 or 78 weeks and you come up to the end of a tax year, if you think you're going to continue to work there, you can, and of course you meet the distance test as well, you can take this moving expense deduction in that first year, or you can wait until you meet the time test requirement in that second year. Note here, you can move somewhere and because it's only 39 of 52 weeks following the move, you can essentially move somewhere and move there unemployed, and it gives you time, not much time, but it gives you a couple of 2 or 3 months to seek employment. Of course, if you're self-employed, normally you're not going to wait. You're going to become self-employed like right away, but still even there, they give you some time to scope things out in your new location. Now, what is assuming you meet the distance test and the time test or business test, however you want to call that, what is deductible moving expenses? Well, the cost of moving your furniture, your vehicles, and the reasonable expenses associated with moving those things and traveling to the new residence are allowed, including, of course, transportation, and also including any lodging in getting to the new location. What isn't deductible? Well, the thing that's not deductible is meals that the taxpayer and related parties incur during that move. Well, why don't they allow meals? I suppose the answer to that is, well, you got to eat anyway, so, you know, whether it's on the road or at home, still got to eat. Now note, for mileage to the new residence, you can take a mileage rate in lieu of the actual cost of driving personal vehicles during the move. And in 2015, that's 23 cents per mile. So it's up to the taxpayer, whatever they decide to do. They can either keep good records and take the actual costs, or just simply deduct the mileage rate. Also note that house hunting trips are not deductible. So that might be a scouting expedition that maybe the taxpayer or the taxpayer and their spouse take in looking for a new residence before they actually move. Those costs are not deductible. In order to help self-employed individuals to receive some of the advantages that corporations get as far as deductible expenses are concerned, they created this health insurance deductible for self-employed taxpayers. And so it provides equity with employees who receive health insurance as a qualified fringe benefit. The insurance must be provided for the taxpayer or dependents who are not eligible for employer-provided health insurance. So that last part there means, let's say you're self-employed and your spouse is employed by someone else and she is offered health insurance through her employment. Can you just elect not to take her insurance and just simply have your own? Well, yeah, you can do that, but you don't get a deduction for that health insurance by the self-employed taxpayer. If it's offered by an employer through one of your family members, and it allows you to be on the insurance, of course, if you reject that insurance, you don't get to take the health insurance through self-employment and deduct that expense. It's not going to be allowed. So the thing to do there, of course, is if your spouse or significant other is offered health insurance, they should take it. Now, when you're self-employed, you're getting kind of the double whammy on Social Security taxes because, well, compared to an employed person has deducted out of their pay Social Security taxes, but the employer has to also match the Social Security taxes. So it's a shared obligation by the employer and the employee. Well, without this self-employment tax deduction, self-employed people would be hit with this double whammy as both the employer and the employee. And so in order to create some equity in the system, since employers are allowed to deduct the payment of Social Security taxes that they pay, their portion, Congress decided to allow for a self-employment tax deduction. All right, now we get down to these deductions subsidizing specific activity. We've already talked about alimony payments. If it is an alimony payment, it's deductible for AGI. Why it maintains equity, I have no clue, but that's what the little thing says here. I mean, the biggest part of negotiating whether something's going to be an alimony payment or something else may be obvious, maybe not, so I'll just mention it. The fact that, you know, if you're talking alimony, you're going through a divorce, okay? If parties are going through a divorce, they have gone from being in love with each other to absolutely hating each other's guts. And so there's not a lot of communication going on there. So how do you create communication lines to even negotiate whether something's alimony or something else? Well, again, look at this. This is not totally equitable. Alimony payments are deductible to the one paying the alimony. That's great. But the other side of this is the other spouse receiving the alimony is, well, taxable on the amount of alimony received. So, you know, trying to convince the other spouse that, hey, this is a good thing because I get to deduct it. Oh, and by the way, you have to pay it, or you're taxed on the money alimony received. It's kind of a hard sell. One of my students wrote a paper on something called tax arbitrage and used alimony as an example where the parties can negotiate, if they can, to where it's beneficial for both parties. So, another little hint as to a paper that could be written. Contributions to a qualified retirement account are deductible for AGI. That's to encourage savings. Interest expense on qualified educational loans. Now, that, let's see, it says that the deduction for interest expense on qualified education loans is the amount of interest paid up to $2,500, but note that the deduction is reduced or phased out for taxpayers depending on their filing status and their modified adjusted gross income. And so modified AGI is defined as AGI before deducting the interest expense on the qualified educational loans. So bottom line is this phase-out period begins at $65,000 if you're single, $130,000 if you're married filing jointly. Actually, it begins on the first dollar after $60,000. So if it's not over $60,000, any amount paid up to $2,500 is deductible as a qualified education loan. Anything over $65,000 if you're single and $130,000 if you're married filing jointly is phased out. So look at the example there. I'm not going to go through it, but look at the example 6-8 to see how they calculate that. Now note, qualified educational expenses are deductible, and notice that there are some requirements. These educational expenses are limited to tuition and fees required for enrollment at a post-secondary institution of higher education. And they say, note that the qualifying expenses is more restrictive than for qualified educational loans interest expense deduction. Not that that's a big thing that I'll require you to know, but just for your curiosity and edification. And notice that there's also a phase out here that starts at this $65,000 level. If you're not over $65,000 and single, any amount paid up to $4,000 is deductible. Then you get into that phase out. If you're married filing jointly, it's twice that amount. And then if you're above $65,000 or $130,000, but less than or equal to $80,000 or $160,000, the deduction is the lesser of the amount paid or $2,000, and then anything above $80,000 or $160,000, if you're MFJ, the deduction is $0. Now notice it says here it's set to expire after 2014, but I believe that Congress did renew that for 2015. All right, starting tomorrow, we'll talk about deductions from AGI, and we'll start with medical expenses.